Good morning, everybody. Welcome to a Vermeer update on the subject of the media industry, which has had a very interesting, quite difficult start to the year, as with most growth areas of the market. And obviously, last week was dominated by headlines from the Netflix numbers, and we'll maybe touch on that later. But the thing actually I thought we would focus on was the situation vis-a-vis Microsoft, which is a stock that we've had in our portfolio, as well as Sony, two staple positions that in our portfolio have done very well for us over recent years. And of course, last week, controversially, Microsoft announced the potential purchase of Activision Blizzard, a gaming stock that had been exceptionally popular and had perhaps run onto slower times. So, Charlie, I just was thinking, this is a sector that you know lots about. Maybe you want to just give us an update on your thoughts on the deal, and there's some other issues that will come up later in our conversation.
Yeah, I think there's various different ways we can look at this. I think to start with, from an Activision perspective, there's no doubt that the company was really struggling in the short term, suffering for loads of reasons, a lot of it related to the culture of the business. There's been all sorts of allegations against the company and the supposedly kind of frat house culture that was going on there amongst the developers, and the chief executive, Bobby Kotick, had kind of brushed all this under the carpet and knew about it. This has all been reported for 6 months or so. So the stock price had reacted accordingly and had been very, very poor. So there's no doubt this is an opportunistic deal from Microsoft. The offer price is only back where the stock was trading, give or take 10 months ago. So it's a very aggressive move by Microsoft in gaming this. 68.7 billion, I think they paid for it, or if the deal goes through. And this is no doubt a very aggressive, as I said, aggressive move by Microsoft in the gaming space with their Xbox franchise. And I don't think you can swing any bones about it. It's a negative for Sony. It's seen various analysts describe it as a declaration of war by Microsoft in the gaming space. It makes total sense for Microsoft. They've got an unbelievably strong balance sheet. The deal doesn't even use up half of their their cash position, their gross cash position. And Sony don't have, although Sony is an incredibly strong financial company, it doesn't have the firepower to do a deal like this. And it's all about acquiring video game content for Microsoft's Game Pass subscription business, where all the games will go onto a cloud subscription service, like similar to any movie streaming company. You pay your, I think it's $15 to $20 a month subscription. You can access all the gaming library that's on there. Microsoft is very well developed in this, and they want to push that further, hence this acquisition. Sony is also starting to put something like this together. But there's no doubt that Sony has to try and come up with some way to counter this, whether they try and block the deal, I'm sure they will, or whether they go out and acquire a different developer themselves, remains to be seen. I think initially the stock price reaction to Sony was way overdone. I think from early estimates we've seen kind of mid to high single digit EBITDA hit within the Sony gaming division. So in the overall context of the business, it's very small, but we've now got to sit back and reassess as to where we think the gaming industry is going to go. Is it going to be the big players get bigger? There's no doubt it's a good time to be a separate independent developer at the moment, because chances are you'll get bought pretty quickly. So have you got any different views to that? Or?
So not particularly. I mean, like you, I think it's a really good deal for Microsoft. You know, it may be opportunistic, but you know, if you listen to the management of Microsoft on the call, if you listen to management of Nvidia, albeit that gaming has seen an explosion of demand, of course, you know, some of that has been pulled forward by COVID, and that, I guess, has slowed, you know, as you know, things have tried to normalise somewhat. You know, I think it looks an obvious extension of Microsoft's growth. What I'm not sure about, and I'll come on to the regulatory side, I'm going to let you talk about that. What I'm not absolutely certain about is the assumption that Microsoft will take all their content from Call of Duty and other top games that they're going to acquire if they're successful in getting the business, that they'll become exclusive, and that will force Sony into, you know, trying to buy something else in the space. My thought process, right or wrong, is that what is more likely is that Microsoft will not actually make their games exclusive, but that they will force Sony also to give up exclusivity on their products and allow them to be on Xbox, which, yes, that is still unequivocally a negative for Sony given where they're at, but perhaps not as bad an outcome as what the market is currently anticipating. And as you said, Sony's situation is that, it's developed a much broader business now. It's not all about PlayStation anymore. Of course, inevitably, it grabs all the headlines because it's always the most front and centre part of their business. But Sony's, well diversified business now. They've done phenomenally well developing other content, both in music and film and things like anime, very strong growth franchises there. So, it's a blow. Certainly, as we weren't taking any action in either stock last week. I think they're still both great franchises. I think if Microsoft can get the deal through, that would be great. But what are you sort of thinking about the way the stocks will perform from here? And what are you thinking about those antitrust issues? Because, it's very difficult to argue that Microsoft, it has a dominant position in the industry. But is it going to sit comfortably with regulators who already fear that big tech's come too powerful?
Yeah, I think it's going to be a balance between, where the rules are based currently on antitrust. Should the deal be approved? Probably yes. Given the current views of the Biden administration and the new FTC chair, Lina Khan, will they want to approve it? Probably not. Because it's, as you said, it's a big tech platform acquiring another big business to get bigger and more powerful and more dominant in one industry.
Yeah.
The exclusivity thing is a question as to what they're going to do specifically around the Call of Duty franchise, which is the biggest game, at least on the console game in the world, as far as I'm aware. Microsoft will say all the right things. But going very aggressive on the monopolistic, take everything in-house is a very un-Microsoft thing to do.
Absolutely.
And so I think they'll be very open about what they want to do. We don't know the state of the contracts between how long they've signed with Sony to make the games available on their platforms. So Sony will say, look, we're acquiring this business. Say Call of Duty as an example is a first-person shooter game. There's loads of those out in the market. It's only one out of 20, 30, 40 of these. Therefore, it's not a dominant position. Mm-hmm. Whereas Sony will say, well, it's the biggest game in the world. It's massively important for console sales. You're restricting sales of this to your main console competitor, with Xbox and PlayStation being the only two real consoles in the world. That's the kind of the definition of anti-competitive, restricting something to your main competitor by acquiring it. So it's going to be interesting. I think looking at where Activision stock is trading at the moment, it's well below the offer price. And the fact that Microsoft gave a 12 to 14 month time horizon, I think, to try and get the deal closed indicates it's not going to be smooth sailing to get the deal through. But I mean, how will the stocks perform? I think the market has been poor generally recently, and I think Microsoft on the day outperformed the market, which indicates that you think investors are taking this pretty positively as the state of what they're doing. They're doing the smart things with their cash, as good companies do. We always say we like to see companies do sensible things after paying dividends and then using accretive M&A. And this definitely ticks that box from a Microsoft perspective. For Sony, as you said, gaming is now a cog in a big business. Music's been absolutely superb for them recently. They're doing very sensible things on the media front in films and TV. So short-term hit to numbers and sentiment, yes. Will it impact the direction of the business over the next 2 to 3 years? I don't think so. Beyond that, it remains a question mark and something that we'll just have to monitor as the procedures go through. But it's going to remain an overhang or a thing in investors' thoughts for the moment, because that's definitely the case. Yeah. But I mean, we mentioned there that unless you've got any different views to myself on the regulatory front.
No. I mean that it makes complete sense to me. What you're saying is, should it theoretically be allowed to go through? Yes, but I have these concerns that the regulator does not want to see big tech, ever increasing its land grab and becoming a dominant force in yet another industry. I mean, Xbox is a great franchise for Microsoft already, and it's going to get bigger and more powerful. Are people going to be comfortable with that? Whether they, theoretically should be, good question. But, time will tell.
Yeah. And you mentioned at the top that, in conjunction with all this in the media space, we had Netflix results back end of last week, kind of mid to late January, and the stock was incredibly poor the following day, down well over 20%. on the back of the poor 1Q guide for subscriber growth. I think it was around 2.5 million versus well over 6 expected, which led to everyone going, well, are the streaming wars over? Are we in a saturated market now? Is competition really having an effect on Netflix's growth? And as a result of that, there was a big read across into all other streaming stocks within the space of the day. I mean, we've held Disney for a while. We like it. Reacted negatively on the back. What's your initial take on everything media?
Plenty of questions straight, of course. But I think what is interesting about that, and this is the difficulty and the challenge for individual stocks and markets ahead, trying to work out what degree of pull forward businesses have seen as a result of COVID, with the lockdown orders in 2020 and the colossal subscription growth that Netflix saw in that period of time. And similarly, it got Disney Plus so far ahead of perhaps where it thought it would have been, followed by an inevitable slowdown that the market's worried about. So these stocks got ready to go. And I was, surprised that Netflix was down as much as 20%. And yesterday, when we had an extraordinary day in markets, at one point it was down another 10. So, it's a very big reaction, not necessarily an overreaction, but, a very big reaction to the news. And I think, we are in this adjustment phase now for a lot of stocks in the market that have been massive winners from the digital transformation and the pull forward of investment and subscriber growth in these areas. And 2022 is going to be a difficult year for a lot of companies that are going to reveal that, they just cannot keep up the momentum that they have seen in previous years. That doesn't make them bad businesses. And of course, it may set up wonderful opportunities to buy some of these stocks in the future, including Netflix, which we don't own and haven't owned for a long term. But, suddenly, Netflix, a stock that we're used to talking about in the context of it being a very expensive growth stock and only valued on the basis of its subs, reaching a cash flow inflection point, talking about share buybacks for the previous quarter. There's going to be a whole different way to look at some of these stocks going forward.
Yeah, I mean, we've talked for ages about, we spend a lot of time talking to analysts, and we ask them, when we talk to them about Netflix, we ask them, when is it going to move past whatever the subscriber number is in the quarter as to what's going to drive the stock. And, we've seen what happens, this quarter when they guide well below expectations. But to your point, the stock is now you can look at it on a normal valuation metrics, on earnings per share multiples, because the stock is going to become a cash flow machine. Mm-hmm. It's going to generate lots and lots of revenue as it drives its current market share. Let's not forget, it's got well over 200 million subscribers, so it's not a small base that it's operating off like some of the more nascent services are in the US. So, if they can drive free cash flow, fund their own content, really kick earnings growth into high gear, it becomes a completely different concept and a different way to look at the stock. And it would be nice to move past, I personally think, whatever subs are. Because as much, I suppose flicking the viewpoint to Disney, as much as there's, Disney Plus is core to the story, and new CEO Bob Chapek's made that his key driver of growth is going to be streaming. There's so many more strings to its bow than just the streaming service, unlike Netflix.
Sure. I mean, I think it's worth saying that as you pointed out earlier, there's been a significant knock-on effect to stocks like Disney. They were very poor on Friday on the back of the Netflix results, and obviously a difficult day in markets yesterday, as we said. Ironically, we wrote part of our year-end piece about Disney and saying, obviously, it had a very tough year. People were concerned about slowing Disney Plus subscriber growth and whether they could get to their ultimate targets and get to the profitability inflection. And at the same time, of course, because of COVID, problems, the parks haven't reopened at full capacity, albeit that all indications are that, the demand for people to attend Disney parks, Disney hotels, cruise lines when they reopen is really strong. And one of the things that, we've thought a lot about, isn't it, is that people are going to want to return to trusted brands when they go back to hotels, when they go to theme parks, when they go cruising. And Disney, we obviously feel ticks those boxes. But what about this idea, as I suggested in the year-end note, that if Disney stock continue to really struggle, and boy has it struggled year to date, it could become vulnerable in a similar way to what we've seen Microsoft bidding for Activision Blizzard. Do you think that this is a moment in time where somebody like, say, Apple, with a massive balance sheet, phenomenal cash flow, clear desire to become a bigger player in content, they've got their own programs that they're releasing now, is this a one-off opportunity to acquire the greatest content that there is? And I think we were reminded of just how powerful the content is over Christmas in a very difficult environment for the cinema. The box office numbers for Spider-Man, which by the way is co-owned by Sony, another positive for them, were tremendous. And no one seems to want to go to the cinema unless it's Marvel or something like that of Disney is showing. So it was a moment in time where we sort of chatted, wasn't it? Said people have rather forgotten about the franchise value of Disney and the content that it owns, and difficult stock price performance last year. And it was a reminder to us, wasn't it, of the strength of their franchise, and that obviously there's a lot of noise around that at the moment. What do you sort of think about that?
I think it was interesting, as you said, we wrote all those things at the end of, or the start of this year, about the value of content, poor performing stocks being under pressure, and we've seen one example of that in Activision. It's a stock that's been under pressure, and it's got great content, arguably some of the best gaming content out there. And I think there's with no argument in our view that Disney has got the best franchises and the best content, and it's one of the best brands in the world. Mm-hmm. And there's always this debate about how long can these mega cap tech stocks keep performing. But one thing that everyone does talk about, the strength, as you alluded to, the financial strength of these businesses is enormous. The huge cash positions that Apple, Alphabet all have, and the ability to use that to drive future growth. And I think it's pretty clear, to me anyway, maybe not so clear to the market, about Apple's intentions within the content and media space. They made, in my opinion, a very smart decision to just, every time you buy a new Apple product, you get 12 months free of Apple TV, Apple TV Plus. That way they go from 0 subscribers to hundreds of millions in the space of 12 months. You leveraging that ecosystem and the power that they've got. And with their huge cash position, they've got optionality to do things. And I think the relationship between Apple and Disney is very close. When Steve Jobs was still chief exec at Apple, he was very, very close to Bob Iger as part of the deal when Iger decided to buy Pixar. Mm-hmm. Pixar was a Steve Jobs business, and they developed a very, very close relationship over the negotiations they had about acquiring it. And remember, you said everyone at the time said, what are Disney doing paying that much money for Pixar? Yeah. It's never going to make it.
Yeah, we looked at the numbers, didn't we? We looked at what Disney had paid for a combined Pixar, Lucasfilms and Marvel.
Was in and around...
And around $20 billion, which if you think about the value of that content now is utterly astonishing. So, they were very far-sighted in that. Marvel, has become a really, really dominant franchise, hasn't it? So, I guess I definitely see it as a left field, potential thing that the market's not focusing on, because for me, clearly, as you say, Apple can get a lot of subscribers by the power of their own business. But here's a theoretical one-stop opportunity to buy the best content on the planet, years of history, plus more recent Marvel, Pixar, Lucas, there's all the content that goes back, many, many years as well, when Disney's share price is struggling and investors have rather, not saying lost confidence, but it's become difficult because they're now concerned about streaming and when are the parks going to get back to full capacity and what's happening with linear TV, which I have to say is very difficult. But what about the regulatory stuff?
Different conversation.
Absolutely. But what about, I guess the difficulty might be the same regulatory issues as we highlighted for Microsoft, Activision. No real reason why the regulator would block it, but will they want Apple to become dominant in another way? I mean, one thing that crossed my mind is, could Apple buy the content and then effectively allow Disney to remain a quoted entity more dominated by the parks business, where actually Mr. JPEG came from.
That's where JPEG's background was in consumer products, in parks. He's been in most of the divisions of Disney. He's a Disney lifer. He's been through most of the divisions over his career. But I think you're absolutely right. It's Apple's share in media, market share in media, is broadly nothing.
Yes.
When you look at the whole networks and linear ecosystem combined with streaming on a global basis. But so therefore, from a competition perspective, there's no real reason why the deal shouldn't go through.
Mm-hmm.
But to your point, it's Apple buying Disney.
Yeah.
Will everyone have massive consternations about it? Yes, they would.
Yeah.
But I don't think it's not a hugely outlandish idea in the, Microsoft can acquire a massive content company for 70 billion, then everyone's up for grabs.
Indeed, absolutely. I mean, I guess, it's worth, declaring that we are shareholders in Microsoft, Sony, Disney. So a lot of the stocks to go. We're not currently shares in Netflix, but we find it more interesting than we have done for a while. I mean, I guess, Disney into this quarterly result might be tricky because, you've still got park shutdowns, and of course, all eyes now post Netflix, even more so on the streaming related stuff. And of course, the other element that we mustn't lose sight of is acquiring content, to that very point, and why Disney is so valuable, is a very expensive business. And one of the things that we've talked about a lot, isn't it, is the fact that Disney have to renegotiate potentially or rebid for the licenses for the Indian Premier League cricket this year.
Yeah.
And, judging by the price people are paying to own franchises in the expansion of the Indian Premier League, it looks like their expectations are that the deal to acquire those rights over the world are going to be massively more expensive than it was the last time around. So I guess that's something, just to highlight that is a shorter term concern. It doesn't affect, of course it affects things because they've got to spend the money if they want to keep the rights. Doesn't change the longer term thesis in Disney in terms of the value of content. But it is worth pointing out that that's a very expensive business. Sports rights has become notoriously expensive, hasn't it?
One of the only inflationary, kind of network rights things out there is just how much, especially US sports rights. You look at what the NFL got for their recent kind of new deal. You could argue after the most recent weekend, they massively undersold those rights, given the unbelievable weekend that we had. But it's definitely something to keep an eye on in the short term.
So maybe, Disney continues to be tricky, but to the absolute point, is that the moment in time where it attracts the attention of unbelievably deep-pocketed mega tech companies who want to acquire content that is, unequivocally the best that can be acquired anywhere on the planet.
Yeah.
Great. Well, thanks for your time on that, Charlie. That was very useful for me. I hope it was useful to some of our investors and potential investors looking in. We plan to do a number of these type of events on a regular basis to discuss sort of topics of the day, and look forward to speaking to you all again soon. Thanks for your time.